What is shadow banking? I'm going to define shadow banking. What I'm going to mean by market-based credit, all of that, is exactly this. Whenever you see money market funding of capital market lending, that's what I'm talking about. Whether it is on the balance sheet of a bank, which it was sometimes, okay, Union Bank of Switzerland is a bank, and it had this sort of thing on its balance sheet. Whether it's on the balance sheet of a non-bank or some specially constructed vehicle or something. Wherever it is, whatever balance sheet it's on, if it's money market funding, wholesale money market funding of capital market lending, I'm going to call it shadow banking. That is in order to emphasize we're talking about a system that has global funding, because it's the global dollar money markets, of local lending. The loans are originated for some local purpose, okay? So that's a key piece of it. The second key piece, market pricing, both money and capital, as opposed to traditional banking, okay, where all these loans are idiosyncratic, there's no market prices kind of anywhere. You're talking about bonds, you're talking about the capital market, okay? So there's a price. There's a price that's being generated in the capital market for these securities, and there's a price that's being generated in the funding markets, okay, for the funding of this. Both of these are market prices, both of these are visible, both of these change over time, okay? That's very different from standard banking. And then the third element, which we know now from this course, when you have markets, there are market makers, okay? There are dealers that are quoting bid-ask spreads, and they're moving those bid-ask spreads, and as they, depending on their inventories and their risk tolerance and so forth, and that's where the prices come from, okay? So that in order to understand shadow banking, you want to shift your focus away from the bank, okay, and toward the dealers, toward the price formation. Here, these market-making institutions. I'm asserting that now. You're going to see more of that, okay, pretty soon. This is my sort of bottom line in terms of what are we looking at, how should we try to understand it. So there's some existing literature. They tend to emphasize the shadow, okay? They're starting from traditional banking, and they're saying, well, what is shadow banking? Shadow banking is banking that's done by non-banks, okay? Or it's banking that's done by somebody who's not facing the same regulations as everyone, so they're evading regulation. Or it's banking that doesn't have a direct government backstop, okay? It's sort of unauthorized. There's something maybe a little fishy about this, a little shadowy about this. So by looking at shadow banking through the lens of Jimmy Stewart banking, it seems sort of illegitimate, or if we start to think about regulation, it seems, well, what we should really do is just move it in, make it into a bank. You know, you move the same regulations over into the shadow banking system. Move the same backstops over into the. So that is, I would say, probably what most economists say. Okay, what you'll hear in most of the literature. I don't think this is very helpful. Once you understand shadow banking as capital market lending, money market funding, wholesale prices, that whole package. This is what I emphasize instead, okay, that this is that the reason we have shadow banking is not regulatory arbitrage and fraud, okay? Not to say that there wasn't regulatory arbitrage and fraud too, okay? There was a lot of both of those things, okay? But I think that thinking that the only reason it's sort of a mistake that it exists, I think it's not true, okay? I think there are fundamental forces that are leading to it as well. Fraud helped to create it, no doubt, okay? But if you get rid of the fraud, I don't think you're going to get rid of the shadow banking, okay? Because financial globalization and the revolution in modern finance are behind this. So when I try to think, so the project I've been involved in, intellectual project, since I finished the new Lombard Street book, is to say, well, what kind of regulatory reform should we have? How do we even think about that? And I propose to think about that by imagining a world in which there's only shadow banking. Okay? So it's not a matter of extending the regulation of traditional banking to shadow banking. There isn't any traditional banking. There's only shadow banking. And if we started with shadow banking and we only had shadow banking, how would we think about regulating that? to be clear, I don't think that's ever probably going to be true. It's never going to happen. But I think it's as a way of framing the problem, it gets you out of Jimmy Stewart habits of thought. Okay, it gets you out of thinking that we have these regulations and we just need to figure out how to move them into this new world. I think that is a disastrous way of thinking about the problem. Okay, it's just creating new obstacles that modern finance is going to be very good at getting around. Okay, you're creating profitability, more opportunities for fraud and regulatory evasion. I think you have to start from a different place. Okay, start from a world of only shadow banking that I imagine. I showed you before in the slide the idea of having, I called it a shadow bank before, now I'm going to call it a capital funding bank so that we get the shadow business out. Okay. And we have residential mortgage-backed securities, and now I'm specifying the derivatives, credit default swaps, interest rate swaps, and FX swaps to strip out all the risk, okay? And I'm showing money market funding, and that money market funding ultimate source is an asset manager here who has deposits and is getting risk exposure with these specific derivative exposures, CDS, IRS, and FXS. So that's just like the previous slide. But now what I'm showing is the market makers in between, okay? Global money dealer who is standing in between the asset manager and capital funding bank, collecting deposits and on lending them. So this is a money dealer, okay, who's on both sides of the money market, borrowing and lending, 3-month deposits, something like that. For funding markets, this is the global funding market. This is where the price of money is established. And here is the risk market. Okay, so I'm showing a dealer is on the other side of all of these derivatives. So this CDS, that's a contingent liability of the asset manager, is a contingent asset of the derivative dealer, and this contingent liability is that asset there. Okay, so the dealer is standing in between the asset manager and the capital funding bank. So now this goes back to the FT article we saw just today, okay? Talking here about a sort of central clearing counterparty. The balance sheets that look like this right now are mostly on the balance sheets of the big investment banks, okay? They were making these markets. They were creating swap books, okay, that were maybe matched book, or maybe they would move them back and forth depending on take positions depending on what they thought was going to happen in the market and the profitability of it, okay? The idea of central clearing counterparties is to kind of move all of these individual positions, the ones that were on the balance sheets of Lehman, the balance sheet of Bear Stearns and so forth, move them onto a central clearing counterparty so that you can see them, you can net them, you can make sure that the prices are being formed properly and so forth. So you can see why that issue is key if the future is shadow banking. If the future is shadow banking like this, these are key. Remember, I told you, we had a mature money funding system, you know, that was tested in the Korean crisis. We have a very immature risk transfer system. This is the part that needs to get cleaned up. You know, we're in early days in developing a system there that works properly at a global level, okay? And that's how I understand all of this discussion about central clearing counterparties. It's an attempt to move to the next step, get this stuff off the balance sheet of individual investment banks, pool it, and then to create some kind of government backstops for the global money dealer. Well, we know about that already. This is the new part, the derivative dealer, okay? The dealers are key, okay? This is one of the things that the money view, the lesson of this course, that the dealers are key. They're the ones who make liquidity. They're the ones who make market liquidity. That's where the prices come from. This is a market-based credit system. This is where the prices come from. If the dealers go away, if the dealers stop making markets, the whole thing collapses. The whole thing collapses. So these are the key entities. Not this entity, Capital Funding Bank. So where a lot of the regulatory energy is focused on this sort of thing, like let's not have short-term funding, let's have long-term funding or something like that. I'm saying, you know, this is looking in the wrong place, okay? Here's the place, here's the part of the system that you want to get right, okay? The dealer part of the system. Now that's an idealization. In fact, notice here, I haven't put in here any liquidity reserves anywhere. You know, there's no cash anywhere, no T-bills anywhere. I haven't put in any capital reserves anywhere except here. The only capital in the system is here in the asset manager. So I've sort of been assuming that these dealers are matched book dealers and they're perfect matched book dealers, and so they don't have to have any capital because they have equal risk on both sides. And that this hedging thing works so perfectly that you really have an actual T-bill here, and so there's no issue. Okay, of course, that is an idealization. Okay, it's not true, but it does start to put you in a different frame of mind from all of this concern, like, oh, we just need to make sure that the banks hold lots of capital. Well, where is the capital that is backstopping this bank, this capital funding bank? That capital is over here, actually, because the risk is all transferred. The capital is not on the bank, on the balance sheet of the bank, it's on the balance sheet of the asset manager, if you've transferred the risk properly, and that could work out fine. Now, because it's an idealization, you don't really want to have a system where the dealers have no capital. You don't really want to have a system where they have no liquidity, but it's a starting place, okay? That's a very different starting place than much of the debate. So I'm abstracting also from retail depositors. There are, of course, going to be retail depositors and outright investors. All my security investors invest with derivatives. Also, I'm abstracting from traditional banks. I'm assuming that the securitization process works fine, that the residential mortgage-backed securities underwriting is fine. You're not going to get garbage subprime things there. I'm abstracting from liquidity reserves, from capital reserves. Also, my dealers are matched book. They're not speculative dealers. We can add those things in, though. And I'm just listing this so that you're aware that I'm aware, that you're aware, that I'm aware, that this is a model. It's an abstraction. In order to focus on the system interlinkages, in order to focus on normal liquidity risk, which I will in a minute, and also to focus on the tail liquidity backstops, both funding liquidity and market liquidity, and that's what I'm going to do now.